quiet when they scared, I sell it when they greedy. I'm always asking why, price always has a meaning, and I always been that guy. If you need to come and see me, turn it to a 5. I'm the opposite channel Dini.
All right, ladies and gentlemen, I hope you're having a wonderful weekend so far. Today, I want to talk about why the stock market is really going down, or the real reason why. Now, it's cool I can make this video right now because I think this is going to age very, very well. It's going to be very timeless, and why it's important now. The market's kind of been dropping and dropping with no real explanation lately, and we're at an interesting point near all-time highs. And just even how people are viewing it, it's, what's the reason why? And I think if anything throughout 2020, even coming into 2021, this is a good macroeconomic indicator, and there's a lot of stuff we could go over that I'm going to explain. I explained it a lot on stream today. I might even clip that for you guys, but it's understanding other factors here. We're going to talk about global currencies, especially just the United States dollar. That's really it. The real reason why we're going down is the United States dollar. Now, there are other things that contribute to that, so I'm kind of going over how you could view it as an indicator, how to kind of keep up into this, and hopefully even just spark something to make you want to go learn this stuff even more, because this is always good information to have. Now, when it comes to predicting a stock market crash or saying the stock market is going to crash, and I've heard a lot of people say this, and I like this advice, not necessarily don't be wary, but kind of be wary of anything saying or anybody saying that the stock market is going to crash here. We make YouTube videos. I've talked about this a lot. I can make a video anytime saying the stock market's going to go down. Anybody can. And I tell people always just, listen to the content at heart, whether it's from me or anybody else. But there's no real way to predict a stock market crash or the stock market going down. How I view this and all the other indicators, it's like a boxing match. Two opponents, they're going, bulls and bears, however you want to look at it. There's positive, negative stuff. But just because someone's in a boxing match, sometimes they will get hit. And then you're like, oh, it's about to go down. And it looks like one more punch can knock them down. Then they get hit one more time, they don't fall, and then sometimes they get knocked down and they come back up. I guess that Tyson Fury fight's coming up here. That's a great example if you saw the last one. But this is the point I'm saying, is that there's indicators where you can say, okay, it looks like things are wobbly or stable, or there's, it's looking weak in some areas, but there's never anything, whether it's the yield curve or all that, that's going to say, okay, this is the exact punch that's going to knock them out. So keep that in mind and use this for, educational purposes. And hopefully this sparks something else. But right off the bat, this is what it is. It is the United States dollar. So there's a few things, and I talked about this on stream, but the reason here being is that now if the dollar gets strong, it brings down asset prices. Pretty much it's all about purchasing power is what we talked about. The value of your dollar today and what it's worth now, it's based on what it gets you. So if your dollar strengthens, that means you get more items for the same dollars. If your dollar weakens and you have inflation, you get less items for more dollars or the same amount of dollars. So this is something that's happening, but what's happening now, and this is what I pointed out, why am I even talking about any of this stuff? And we're seeing it a little bit more here, if anything. Oh, wait, that's the dollar. Well, these are all the dollar charts, and you could see it, and this is something, over the last few years, we are at, we're near all-time highs here at the dollar. 2020 here, we clipped highs in 2018, 2019, 2017, all that. It's not letting me go back further on the chart. There it is. So, lower than we've been in the past, but all of these times, when the dollar is shot up like this and you've seen the dollar go up, it's usually at the times of crises. So I'm not going to get into the deep depth of, dollars becoming, more accessible and easier and harder and all that. But the point here now, there's a few things happening. This is the dollar, but now looking at Japan, and this is something I talked about here. There is usually a big correlation, and then this has recently snapped just in this last 3 days. And this is why, again, why I'm talking about this stuff, because you don't really see this happen a lot. And usually Japan is a safe haven currency. So what happens here, supply and demand, as more demand for a currency increases, it strengthens. As it weakens, as demand fades, the currency will weaken. But now here, what's happened with the yen is that it's weakened when now it should have strengthened. And now the reason is why, and this is even now, again, with the dollar, the coronavirus, pretty much a theory I'm even looking at here that I'm coming up with is just simply a lot of these correlations and things are going to play out a little bit differently because of the virus. You're going to have people naturally rush just to the dollar as this virus spreads in some of these Asian countries, and it slows down their economies and some of this stuff. And that's even, today we got negative PMI data, which is showing manufacturing data. And this is what I was saying, watch for this this shift because now all the slowdown from China in the last few weeks, and that's what I'm saying, depending on when you watch this video or how this virus plays out, we're going to actually just start getting data reflected through economic reports here in a few weeks. And if this is, it's usually 4-6 weeks trailing. So that's why this stuff's going to come out. And that's why I've been saying, watch the currency. And the thing that has been moving most, even though oil has dropped and everything, it has been the dollar. It has been the dollar and currencies which have been moving before anything. And if these get destabilized, it could have a negative effect, or not necessarily a negative effect, but what it creates is a rebalancing of pricing. So as currency values fluctuate all over the world and change, and if they change a lot, it's going to change prices and the cost of stuff, or vice versa. If things and items become harder to access and buy, that's going to change the value of currencies. But now back to Japan here, this is why it's unusual what happened here, because this is the safe haven currency. There's a lot of money from Japan in the United States, and people in China, if they want to invest through the United States, sometimes they'll bring that through Japan. And now what happens here is that usually when the stock market in the United States goes down, Japan strengthens. So if this chart goes down, that means Japan's currency strengthened. And why is that? Because people sell their dollars, or they sell out of stocks, then they sell their dollars, and then they repatriate those funds back home. So they turn their dollars into yen. That increases the demand, and that strengthens the currency. That's one of many reasons why when it comes to Japan, and again, just how their even economy is controlled, the Japanification. We won't get too much into that here, but you could pretty much see here anytime, January 2016, this was after the flash crash. The flash crash, they strengthened greatly after weakening a lot. That's what led this massive weakening preceded that 2015 flash crash in China. Then when the market started dropping again 2016, you saw a massive strengthening. You come here to Brexit in June 2016, same thing. Pretty much anytime this U.S. market has dropped a lot, you've seen it followed up again, 2018, 2019. You've seen it followed with the yen strengthening. So this is very weird now that the market's kind of panicking with bonds. And again, you would see bonds do the same exact formation. But now that you're seeing Japan weaken, this is saying something. So now if Japan weakens, that means that the currency has strengthened here in the dollar. So this is now the main point I'm getting at, is watch the dollar, because above anything now we are seeing since February 2nd, February 3rd, the dollar has just gone up and strengthened. And that's something we pointed out today on the live stream, that you're going to see a dislocation. And this is stuff I'm saying watch out, because, and keep an eye out for, because just because you see the dollar strengthen or you see something happening with bonds, and that is what I think is the most important thing, but it doesn't have to be reflected right away. Sometimes, it doesn't mean that bonds are wrong or the market's wrong, or again, the market is so big and it's so slow. You could have this push and pull where different actors are doing different things, or there's different influences. So here you take a look from February 3rd, that was the Wuhan drop, and then we started coming up. You see it's just been going up from the 3rd, 4th, 5th, but we take a look at the dollar here. The dollar has just had a straight rise, so it's going up even more. But even before that 1st or 2nd, think about right here, come back to January 23rd. That's when the Wuhan fears started. The dollar didn't drop, though. Those first few days the market was going down, the dollar was rising, then it finally dropped, but then 2 days later it continued its whole thing. So now another correlation we've looked at is oil. This is oil here since the beginning of the year. It's dropped, but what has the dollar done? If you notice, it's the exact opposite. The dollar's gone up, and that makes sense why your dollar has strengthened. If the price of oil has dropped, more than 10% in the first year, or in the first month or two of the year, it's come up a little bit, that means you could get more oil for less dollars. So you see how the price of stuff changes, and now this is essentially what I'm getting at, is we're going to see all of this stuff reflected at some point, or if anything, this is the big risk. Now gold is going up, and now this is where it gets interesting, because some people have asked now if the dollar is going up, that should make gold cheaper. Well, it kind of goes inverse sometimes, or now it's just showing a higher demand for gold, which makes sense now, because I think people with the virus and everything going on, I think people are rushing into the dollar. Again, if the U.S. has the least likelihood of it coming here, or we have more resources to keep it contained, technology, you could see why we are kind of the safe haven. More people might put their money into the United States as a safe haven. That's why they're going into bonds. But now, too, if they don't even trust anything, they're going to start going into assets like gold. And that's why, gold is making a very big run up here. It's not the all-time highs, but, compared to 2008, 2010 and all that. But it's getting up there. But putting this all into perspective here now, this is where I'm saying, I think as we see 2020 play out, the indicator I'm going to be looking for is a mass strengthening of the dollar. dollar. And if the dollar starts breaking above 100 and it starts hitting certain points that, are relatively high, and again, anytime the dollar has gotten too high, it's been bad. You could even see that preceding 2001, 2002, when we started to get the decline. The dollar topped out before it started to really plummet with the market and everything else. Same thing in the 80s, and I think you can see the same thing even in 2008, 2009, right before everything started to crash. You saw the dollar shoot up a lot. So again, watch this in the other global currencies, but this is what I'm going to be using as an indicator to see, if there is other concerns. I did pair this, the next biggest indicator, and again, these are all what I call the pop-off indicators, is watching bonds and if bonds set new low. But this is also something we've talked about here today, because the bonds are showing you where big money is going, and this is what people feel. And if now the bond rates start going down, that means the demand is increasing. So this is where I'm saying, the SPY is kind of the last one to react, but it seems like the dollar is just leading the way. Then it's bonds. If the bonds, if the dollar increases in value, that benefits bonds, because bonds, you get the same amount of money back. So these are all little factors that feed into it. It is very complex, but it is simply, showing that if the value of the dollar goes up and you increase his purchasing power, and that, this is now more to understand why the dollar would increase, because now other countries will have their currencies weaken. And if there's now this external effect like the virus, you have to think why that would happen is because now these countries like China and Japan, they might start issuing stimulus. They might throw money out there. And then also these countries will weaken their currencies to try to attract imports, whether they need a rebound or if they can't get it from anywhere else, they're going to just be using their printed government money that they're getting to buy stuff from the United States. So think about it. The dollar's going to go up in value even more while their currencies even weaken now. So you see why even people would go towards bonds and the dollar strengthening. But this is how it's like it's all connected. And this is where I would encourage you guys to look into balance of trade and how that stuff works, because this is now a visual representation, or the price of the bonds and the price of especially the dollar, especially compared to other currencies. It's letting you know really where the global economy stands and which places are doing good or bad and need stimulus or don't need stimulus and are trying to attract imports or exports. So keep that in mind. But I think throughout 2020, it's not saying that the market is going to go down, but if it is, I think we're going to track it accordingly with the dollar and then bonds. It's going to go back and forth, because bonds now, you have the Federal Reserve. They're doing yield curve control to a degree. They've talked about that. And ironically, that is what the Japanification of the economy is. This is something Japan has done. And again, looking into Japan and where, Japan and China, and then, even the euro and the pound, some of our biggest trading partners, those are going to be important to watch. But at the end of the day, the dollar is going to show you the culmination of pretty much anything. And if this gains too much value, this is going to have a detrimental effect. Or if you start to notice the dollar increasing in value, try to pay attention to how the value of the dollar moves in relation to now the value of assets, stocks, even real estate. So I'm going to leave it there. There's a quick little history lesson. Hopefully that makes sense. Hopefully this gives you insight. I really say watch the live stream that we had. Today's date, it was February 21st, 2020. If you watch the live stream on the live streaming channel, youtube.com/the stock market, go towards kind of the end of the day. We explained all of this in a lot of depth with really why this was so shocking. And this was shocking today, and this was very confusing for a lot of people. This is I wouldn't say an unexplainable event, but this is definitely a surpriser. It has broken a very, very large historic trend when this happens. So there's stuff brewing. And again, we see that with bond markets. We see that with the value of the dollar. So keep an eye out on all of these. Stay safe. Don't panic. The code loves you, baby. And keep your head in the game, baby. Let's go.